Hey, everybody out there with us once again is Mark Collinsworth of Vere Global Financial Wealth Management. And again, he's with us for a very good reason. The stock market opened today, this Monday, following dire predictions that it was going to be a global meltdown. That didn't happen. But, Mark, why didn't it happen despite all these dire predictions from prognosticators? And what is ahead? Will it happen eventually? What's going on?
Well, thanks, Larry. So many people predicting it. This is what I always tell people. If you hear it on the news, it's probably too late to do anything. People have already sold the positions and all that kind of stuff. So since everyone's already sold, you're not going to get a crash. But to answer your question, with the Fed raising interest rates as much as they are and the US dollar going up, the dollar's up almost 20% on the year. I just predict more pain and more gloom for investors.
Yeah, well, actually, that's the game plan of the Fed. They said Powell has admitted that there's going to be pain ahead. They have to raise interest rates to, in effect, crash the economy to some extent, big job losses, so that way they bring down inflation. Correct. So, I mean, this is on course of what they want.
Is correct. And if you also look at stock valuations are way overvalued in relation to where interest rates are at. So I just predict more gloom, more pain, and more agony. If you're not sitting heavy in cash, well, you're probably just going to be in more pain.
Okay, now this is the beginning of the week that people, are fearing is going to be the beginning of the big crash ahead. What do you see ahead for this week?
Well, historically, the last week of the month is normally positive, but this week is kind of unusual because you have two big Jewish holidays coming up, and that usually causes volume to go down dramatically. So I anticipate this week, any bad news that comes out because volume will be so low, I expect you could see a lot more volatility. Volume drops. So if there's any kind of really bad news, you normally see the stock market sell off really heavy. Of course, the flip side, if there's any good news, which I don't see any good news coming, that could mean big upswings as well.
All right, so well, I mean, how soon the upswing and how bad will it be by the end of this week, do you think?
I think you could drop a little more. The market has gotten oversold, but I think here over the next several months, you could easily see the market lose another 7 or 8% very easily over the next few weeks.
All right, so when are we going to hit the bottom on this?
Well, that's really going to depend on the Federal Reserve. Either the Fed's going to have to stop raising interest rates or stocks are going to have to get really cheap in relation to where inflation's at. So, to kind of answer your question, stocks won't be cheap based on where inflation's at until we get down to somewhere around 2,900 to 2,800 on the S&P.
All right, there is no doubt that we're already in a recession. How deep is the recession right now, and how deep will it become as the weeks go by?
I think for, the economic indicators are starting to slow, but the Fed's not targeting, ISM or consumer confidence. They're targeting the employment rate. And right now, there's still more jobs being created for two reasons. People are returning to work because they got, due to lockdowns. And also, interestingly, people that didn't have jobs that were out of the workforce that may have been doing, little odds and ends, making $50 here, $20 there, they were content with that. But now, because inflation's so high, they're being forced to get jobs to make ends meet, and that's causing the employment rate to decline. So, to answer your question, I think the Fed is actually going to be targeting somewhere between a 5 to 6% unemployment rate. So that means we're going to have to lose several 100,000 jobs between now and then before the Fed's going to stop raising rates.
All right, now we're heading into October.
Mhm.
Some people say that's the witching month with Halloween coming
Yep,
up and all that.
correct. October has historically been a bad month for several reasons. One, it's for mutual funds, their fiscal year ends on October 31st. So if they want to lock in losses for their shareholders, they have to do it for October 31st. And that basically comes back to why October 31st with the laws and stuff, it actually has to go back to actually Halloween for a little bit because when the United States was a farming nation and not an industrialized nation, banks had to keep extra liquidity on their books for farmers coming into the banks during the month of October harvesting their crops. So banks had to sell their stocks.
So therefore, that made the market more volatile.
More volatile before the 1930s.
And then what came in after that was the Bank Regulation Act that kind of put a break on all that.
Well, yeah, they kind of use October 31st as kind of the cutoff line because of the farming, but we're no longer a farming nation. But those same financial firms still have to abide by those same laws that were written basically 90 years ago.
But Glass-Steagall, how does that factor into it?
The Glass-Steagall Act's actually been done away with. The Glass-Steagall Act, which was actually written in 1933 to prevent the stock market or the housing market from collapsing from excessive loans, was repealed in 1999, which, by the way, I like to always tell people Bill Clinton was president in 1999, so you could blame it on the Democrats. And once Glass-Steagall was removed, all the same things that banks could do prior to the 1930s, they were allowed to do again, which ushered in the housing market crash. And then they wrote a new law called the Frank-Dodd Act, which, in my opinion, does nothing whatsoever to solve the problem. It's just two senators that wanted their name on a law.
Glass-Steagall was put in by Roosevelt after the crash of 29. It separated savings banks from investment banks, correct?
Correct. It actually put a Chinese wall between the two so that banks, your traditional banks, can only do loans like, mortgages, car loans, things of that nature. And your investment banks could do investing and stocks and bonds and stuff like that and use leverage. When Glass-Steagall was repealed, there was no difference between what a traditional bank could do and what a brokerage firm could do.
All right, so it was the lack of the putting the brakes on with the Glass-Steagall Act that contributed to the market being overly inflated, leading to the crash of 29, correct?
Well, more importantly, it actually had to do with leverage. The banks in the 1920s could actually go out and actually buy stocks. So if you deposit $10,000 in your checking account and thought it was safe, that bank could actually go out and not only buy stocks with that $10,000, which was your money, they could also go out and borrow money against that $10,000 and actually invest 20 or $30,000. So when the stock market crashed, it was your money being lost, not the bank's money being lost.
So the whole thing snowballed, and that's what led to the crash.
Correct. Several things happened. So when the stock market started going down, banks couldn't basically give people their money back because they were losing in stocks. Then people heard, well, hey, I can't get my money out of the bank because they can't meet the redemption. So people started going to the banks demanding their money, and the banks were forced to sell more and more stocks, which has contributed to the crash.
So it was the repeal of it in what, 1999, you said, right?
The Glass-Steagall Act was repealed in 1999.
Under Clinton. And so did the repeal of that act in 1999 contribute to the current crisis that's developing in the stock market today?
Well, no. The repeal of Glass-Steagall in 1999 actually contributed to the crash of 2008. In
Right.
2010, they wrote the Frank-Dodd Act, which was supposed to supplement Glass-Steagall, but again, it didn't do anything. It was a Dodd-Frank was just a bad piece of legislation. But the problems contributing to today's market is because the Fed has pumped so much money into the economy, and the government has basically written so many stimulus checks. There's so much money out there. Not to mention the lockdowns have caused supply to go down, but the extra money has increased demand. So it's one problem after another, causing more and more inflation together.
So that would have happened with or without the Glass-Steagall Act.
Or what Dodd-Frank today, correct?
Yeah. And Dodd-Frank, it didn't really have much meat to it. What explain that about how what Dodd-Frank was supposed to do and what it hasn't done.
Well, Dodd-Frank was supposed to replace Glass-Steagall. Well, Glass-Steagall was only about a 30-page document. It was very clean cut. It basically said, hey, you cannot do these things. Dodd-Frank is somewhere as close to 30,000 pages, and it says you can't do this, but you can do it if you do this or this. And there's so many loopholes in it. Dodd-Frank really did nothing whatsoever. They should have just reinstated the Glass-Steagall Act.
So Dodd-Frank was purported to replace Glass-Steagall and put some brakes on the trading, but it really did very little. So in effect, it was the repeal of the Glass-Steagall Act in 1999 that contributed to the current chaos in the stock market.
Well, it contributed up to 2008, and even then, with Glass-Steagall, banks can still do the same things they could do before 2008. They just now have an extra loop they have to jump through.
Yeah. So, Mark, considering what's going on, and you've said and others have said it's going to get worse. How much worse, and how soon would the turnaround be?
Well, again, that comes back to what the Federal Reserve. If the Federal Reserve cannot get inflation under control, you're looking at a stock market. You may not want to invest in stocks for the next 2 or 3 years. It could just be a slow grind down.
So I know that you're telling your clients, you're a money manager, investment counselor, you're telling them that a lot of it should go to cash now, correct?
Correct. You should avoid stocks like the plague right now.
And how about bonds?
Avoid bonds. This year, you could put your money in stocks or put your money in bonds. The losses were the same. Bonds are down 20% on the year. Stocks are down 20% on the year.
So if you go to cash, or mostly to cash, uh, if the dollar declines, then what?
Well, if the dollar declines, that's going to depend on, do you own stocks outside the United States? But that's another issue that's going to affect companies at some point this year. The dollar has gone up so much. Give you an example, McDonald's gets over 50% of its profits from outside the United States, but the dollar's gone up 20%. So just based there, if everything's a status quo, McDonald's earnings should drop at least 10% just because of the stronger dollar.
All right. So therefore, if you go to mostly cash now, is that going to leave you holding the bag eventually too, considering inflation and all that's going on now? In other words, is going to cash really a safe haven?
Well, I think so, because if you go to cash right now, the money market accounts can get you maybe, 1.5, 2% in interest. Yeah, inflation's running at 8. So at an 8% inflation rate and 2% interest in your money market account, well, you're really only making 6%, but a 6% loss due to purchasing power is a lot better than a 24% loss in stocks or bonds.
So there's no stocks or bonds to hold on to at this point.
I wouldn't own any stocks and I wouldn't own any bonds at this point.
So that leaves just cash.
Just stay cash.
All right. Now, the technique with that, with cash, is to buy back stocks when they reach a certain low and you predict that they're going to rise again, right?
Correct. You normally want to wait until stocks become cheap, but stocks right now, because of all the Fed stimulus over the last decade, stocks are a long, long way from becoming cheap.
So it'd be a while before you would advise your clients to buy back stocks.
Correct. And again, a lot of that depends on, because interest rates have such a big impact on stocks. If the Fed was to start cutting interest rates today, then the valuations on stocks would change. But I don't see that happening anytime soon.
All right. Now, before the midterms, which are just around the corner now in November, uh, is anything going to change economically to help the Democrats and to help Biden's approval ratings?
They're trying to pull all kinds of tricks to buy votes. They're pumping tons of oil out of the SPR to try to get gas prices down. They're doing the student loan things. They're just trying to buy votes. But here's the kicker: it might buy some votes, but the things they're doing today to improve the midterm votes, those things are going to come back and bite them even worse the actual election. So these things today they're doing today is going to make inflation even worse 2 years from now.
All right. Well, how about for the midterms, which are a month away?
Well, they're trying to basically buy votes. So I don't think it's going to help that much. They think it's going to, but people are really, really furious with the current policies. I mean, look at what's going on in Italy right now. The wokeness, or the liberals, have just really made a lot of people angry.
As a matter of fact, that'll be a topic for our next discussion. What's going on with Italy and how that seems to coincide with historic cycles that you've talked about before. But wrapping it up now, I'm understanding that gas prices will be going up again. Is that true? How soon and how much?
Well, gas prices probably right now, Biden's basically just using the SPR, the Strategic Petroleum Reserve, which has been set aside in case of a war for the military tap in. He's just been using that like crazy. We're now sitting at near 40-year lows in the SPR to get oil prices down or gasoline prices down. And then right after the election, he's going to stop it, and those prices are going to start going back up because they have 2 years before the election. So it's just trying to buy votes. It's just a mess.
But will gas prices rise again before the midterm elections?
I don't think they'll rise before the elections because of the SPR being used like it is. After the election, they'll stop the SPR, and not to mention gas prices and natural gas prices will probably skyrocket going into the winter because people are going to basically it's going to be cold. And then two, I have a feeling Putin is probably going to cut off the natural gas supplies in Europe during the winter to really put pressure on Western Europe. So that's going to drive up prices even more.
All right. So heading into election, it's not looking really that much better for the Democrats, no matter what positions they're changing now and how they're changing the narrative and the rhetoric.
Correct. I think it's just going to be a red wave come November.
Well, we'll see. Mark Collinsworth of Vere Global Financial Wealth Management, thanks once again for being with us. And we'll be talking with you more this week about other trends that we're seeing, especially about what's going on in Italy and how that corresponds to historic cycles of what happens politically and economically. Mark, see you soon. Thanks.
Thanks.